Moody's downgrading Salesforce as the company reportedly kicks off a debt sale of up to $25 billion to fund some stock buybacks. Our Deirdre Bosa is watching that in today's Tech Check. This is definitely making the rounds, Dee.
It is. Morning, Carl. So one way to read this deal is that Salesforce is borrowing to buy time and not growth. Now, this would be the largest bond sale in its history, and it's likely a show of confidence from management. But the money is not going towards a new product acquisition or AI infrastructure. That's the stuff that everyone else is spending or borrowing for. Debt-funded buybacks, they work only as long as the underlying business itself justifies the bet. For Salesforce, the poster child of the software sell-off, tripling its debt to prop up the stock price is a gamble that AI disruption fears are overblown. But if management is wrong, the balance sheet could make things worse. Now, to be fair, you can see why management feels confident on the surface. They just beat earnings, revenue over $40 billion, free cash flow. Agentforce, their AI platform, is growing nearly 170% year over year. But you dig a little deeper, and Agentforce is actually still less than 2% of total revenue. The stock is down over the last 5 years. And while other software names like ServiceNow, Datadog, Shopify, while they have bounced this month, Salesforce is flat. So the market is starting to pick favorites in the SaaS sell-off. CRM isn't one of them, at least yet. One more thing that's worth flagging here, Salesforce pays its employees roughly $3.5 billion a year in stock. That dilutes existing shareholders, so a meaningful chunk of every buyback, it's not actually returning capital, it's just offsetting stock-based compensation. Now, investors have spent years telling Mark Benioff to stop doing acquisitions and return capital, so that's what he's doing. And Sarah, I know that you spoke to him. He said the number one great value out there right now, it is CRM, it's Salesforce. But he might be right, but levering up to buy back stock, that is the playbook very reminiscent of IBM and the old Oracle before AI, not a company that is pioneering a new AI age.
Yeah, I mean, they just feel a lot of conviction about where the stock is right now. And it was interesting, I also, in the interview, asked him about M&A, because all these software valuations, you know, according to him, have gotten so cheap. And he said there are a lot of interesting opportunities out there. It didn't really go beyond that, but said we have a very disciplined approach to M&A because, as you said, he's been pushed by investors, I think, to be really disciplined when it comes to that answer and the use of cash. But it's not like he's the only one borrowing. I mean, Amazon, or a lot of them are tapping the debt markets right now.
Yes. And I'm so glad you bring that up. I didn't have time to get to it in that segment, but that is a key point here. So others like Amazon and Oracle, even Alphabet, they are borrowing, but they're not borrowing for buybacks. They're borrowing to fund growth. Many of them are spending on infrastructure, which will bolster the AI bet. They have sort of a plan, whereas Salesforce and Benioff, they're borrowing to buy back stock. They don't have any better ideas. I know he's been burned by M&A activity in the past, but I mean, you're living in the age of AI. And Sarah, you're exactly right. There may be some compelling companies, beaten down companies out there. He's choosing to buy back his own stock instead of spending on a growth playbook.
Yeah, well, that one's been beaten down too.
That's generally the big complaint about buybacks over time, is that if you don't, if that's your best idea for capital, you got a problem. But to Sarah's point, maybe high degree of conviction that the shares are truly undervalued.
Yeah, right? I mean, and he was here on the show last week to make that case of what they're seeing in terms of underlying growth is it's accelerating because of AI in the CRM business, and also that they're adding business in Agentforce as well, which is, I think, you know, up to $800 million.
I know. I go back to the Agentforce thing, though. Yes, it's compelling, but I mean, this is a company growing at a much slower rate than it has, you know, years ago, and Agentforce still just 2%, less than 2% of total revenue.
Yeah, no, 10 to 12% is not, you know, the 20%, but it's also gotten a bit bigger. I think he would know, to become a little more mature and a bigger company. Deirdre, thank you. Deirdre Bosa.